Hello everyone, welcome to macroeconomics. Today's topic is classical macroeconomic activity and the self-regulating economy. Let's get started with today's session. Thank you for joining. The classical view of the economy is referred to as the era of the classicals. And the classicals was a time period during the 1750s to the early 1900s. The classical period was well defined by several economists that stated different views of the economy and how the economy will work. One of them would have Shea, who came up with the view of the economy that stated that supply creates its own demand. The supply of goods and the production of goods, if you produce it, if you create it, it's good enough, it will create its own demand. And the production itself could be of any particular good and will create enough demand to purchase all of the goods and services that the economy or the firms or the entrepreneurs will produce. That's the classical perspective of the production side for a small point perspective. And the discussion for today is how the classicals, which consists of several economists, actually view the economy and how different things can operate within the economic activity. Now, the classical perspective here has a view on the interest rates and the level of savings. And they argue heavily that if people save their funds, they will save the funds, and those funds will be allocated for potential investments. So we have what is called the savings investment identity. And the savings investment identity is a basic identity that specifies that when funds are saved, those funds could be used for investment later on, for economic investment or in financial markets for financial investments. But here we're looking at economic investments. So when it comes to the view on interest rates and savings, the classicals saw that an increase in savings could increase the amount of funds available for investment. And it could have an effect on the interest rates. If there's more level of funds in terms of savings, that will increase the supply of savings, and the amount of funds available for investment could actually increase. So if you have greater in this identity, if it specifies that if your savings increase, the potential investment abilities increase. If your savings decline, your investment abilities decline. So the classicals have an interesting view of the economy that actually dominated the view from the 1700s all the way to the early 1900s until the Great Depression because of how they saw the economy and how it behaves. Let's analyze further the interest rate model and how the interest rate model is viewed, in this case for the interest rates adjustment process. So the classical view on the credit market. Keep in mind that this model was derived a long time ago, and the perspective on interest rates here is that we have interest rates on the vertical axis, and the demand of funds saved, it's on the horizontal axis, the available funds here on the horizontal axis, but it's a very important model. The supply of funds here is illustrated by the supply curve S1, and the investment demand for funds, the investment demand here is represented by the downward sloping orange curve. And in equilibrium 1, we have the level of interest rates 1, and the quantity of funds here is 100,000. So at the equilibrium 1, the number of dollars that households have saved equals the amount of dollars that households are going to use for investments at an interest rate I. If there's an increase in the amount of savings, and the amount of funds available for investment, that will increase or create more funds, and it will put a downward pressure on the interest rates. The equilibrium will decline, interest rates will drop, and the interest rates will decline here, and it will increase the amount of funds available for investment at a lower interest rate. This is very important because it's still consistent for today. When you increase the supply of funds available in the market, the interest rates drop and investors or individuals borrow more funds for investments. So the greater the supply of funds, the greater the actual amount of funds available for investment, and the lower the interest rates. There have been situations that the interest rates have dropped to nearly zero, or in some cases negative rates, where the supply of funds is significantly increased, and the amount of funds available for investment it's significantly greater. Here's 120,000 at a lower interest rate. And it's a basic classical view of the interest rates, or what is called the interest rate liquidity model. Liquidity, the amount of funds available in the market for investment. So they have an interesting view on the supply of funds that they could be used for investments, and the interest rate, of course, is the interest returned on those savings that are held by financial institutions, or if you're supplying the funds to someone, you charge them an interest rate. And the lower the rate, the greater the amount of funds available here for investment, and more people will want more funds at lower interest rates, and the increase in the supply of funds will, of course, make more funds available for investments in this case. So the savings investment identity is very important. More savings, greater supply of funds at a lower rate, and the number of dollars demanded for investment increases as well. Very interesting view on the credit market and the role of interest rates in the market. With more investment, there's more economic development, more prosperity, and more growth. And the classical view in this case was a hopeful view of how investment stimulates savings, stimulate investment through the credit market, and that investment creates economic activity and develop the economy further. Building on the classical view, the classicals have an interesting perspective on the role of prices and the role of wages for labor units and labor inputs. They believe that the prices are flexible and wages are flexible, meaning that if the economy expands, prices are flexible upward. If the economy contracts, prices and wages are flexible downward. They saw that prices naturally adjust to market changes and market conditions. They also see that markets are significantly and strictly competitive. Most markets behave in a competitive manner, which is relatively true. Most people compete in the market, and markets are highly competitive. Firms are highly competitive, always competing for market share and market power. The role of prices, that one is a little bit questionable. The perspective was that if the price level was to adjust based on, and the price level and the wage level also adjusts based on market changes and market conditions. The third perspective is the supply and demand operate in all markets. We have the twin forces of supply and demand operating in all markets, and that's for the most part holding for most goods and services. There's a supplier, there's a producer, and there's consumers that are demanding the products. So most markets do follow the traditional supply and demand perspective. The fourth point here is that if the labor market has a surplus or shortage of workers, it will be temporary. The market will naturally adjust. If there's a high surplus of workers, that is not referred to as surplus, as if there's a lot of unemployment in the market, there's a lot of people that want to work and they're unemployed, it will be for a short period of time. And if there's not enough workers, the market will recognize that there's a need of workers, it will be for a temporary period of time. That period of time could be less than 6 months or however long it takes for the market to adjust. So number point, flexibility in prices and wages, and flexibility in the surplus of labor and the shortage of labor. Those two are a little bit still questionable because prices are sticky, prices are fixed for the most part in the short term, and later adjust. They don't move right away. But we're looking at the classical perspective and how they saw the economy. The economy, one of the fundamental pillars of the classical view is that they fundamentally believe that the economy will self-correct itself if any issue is presented. If there's any major issue in the economy, leave it alone. The economy knows best. The market forces in the market will lead the economy to a self-correcting mechanism. We don't need to intervene because the market knows best. It's the classical laissez-faire perspective of the economy. The question is, how long would it take to self-correct? And the economy can go through 3 different stages. And those 3 stages of the economy is a recession. A recession typically lasts 6 months, which is a mild recession, very slow recession. 6 months to a year, 6 months to 12 months. That's a moderate recession. 12 months to 18 months, that's a severe recession. 18 months to 24 months, that's a great recession, significant downturn. More than 24 months is a depressed economy. The longer the recession, the longer the longevity of a recession, the greater the economic impact. In a recession is not good. It's a bad situation for the economy since productivity declines, businesses go bankruptcy, and unemployment increases, and essentially economic growth declines during recessions. Then we also have periods of inflation. And inflation is ongoing. We have stable inflation. I often like to refer to as that 70s show that is famous on TV. Back in the 70s, things were like 10 cents a movie, $1.50 a dinner, and so on. Now, if you look at 50 years from then till now to 2020, everything's more expensive. Some inflation is good. Rapid inflation or periods of inflationary pressures are harmful for the economy. That's an increase in the overall capacities of an economy, an increase in the price level, substantial increases that can destabilize the economy's currency and stability. So an inflationary gap is when the economy overperforms. And then we have the cases of long-run equilibrium, when the economy stabilizes and reaches long-term growth and long-term stability. Supply and demand are working well and everybody in the market is doing well. We're going to analyze each one individually and see what are the effects and the economic model of a recession, inflation, and long-run equilibrium. When we experience a recession, during a recession, the labor market is heavily affected. If the economy experiences a recession, the unemployment rate will be significantly higher than the natural rate. And the natural rate of unemployment is somewhere about 4 to 6%, meaning that there's always going to be some people that are naturally looking for work, getting out of college, quitting their jobs, or in transition. That's a natural behavior. But when we have a recession, the market contracts and things don't work well. We have unexpected situations that lay off people. The unemployment increases above the natural rates. The actual rate of unemployment is higher, significantly higher. And a lot of people may end up needing work. So we have a surplus of workers. And it's not a pretty situation during recessions. We had the major financial real estate recession in 2008, 2009, 2010. In the most recent one, which was COVID-induced, the economy's downturn, it led to significant unemployment levels. And recessionary periods can last significantly as low as 6 months or as high as 24 months or more, depending on how severe they are. So a recession is a period of low economic activity. It's a downturn in the economy. And it can be measured, in this case, by estimating a gap from the natural capabilities of the economy to its current actual production levels. So we're going to call it a recession gap when you analyze how big is the recession from the natural ability of the economy to perform. So the gap itself, the recessionary gap, is the condition in which real GDP, the actual real conditions of the economy measured by gross domestic product, is producing below the natural abilities of the market during regular times. That was like when things are doing well, when there's no major effects affecting the market. The model here indicates that if we have the general price level on the vertical axis, the level of gross domestic product in the horizontal axis, which measures economic activity, the aggregate supply curve, and the aggregate demand. Right now, if the short-run aggregate supply curve intersects aggregate demand at equilibrium 1, the economy is operating here. The real equilibrium GDP, Q1, is below the long-run aggregate supply capabilities of the economy. Basically, if all these three curves, supply curve, the demand curve, and the long-run aggregate supply curve are not intersecting right in equilibrium or right in the center, the economy is not in long-run equilibrium. Right now it's in short-term equilibrium, which is indicating that it's performing below QN. In QN, it's the natural level of real GDP during normal economic activity in the long run. And if you look at this model, there's a gap. There's a recessionary gap. The gap between Q1 and QN, it's the recessionary gap. The actual GDP is below the normal conditions of the economy or the normal GDP, and there's what we call a recessionary gap, a recessionary period. And the bigger the gap, the bigger the recession effects, the bigger the contraction, the bigger the downturn in the economy. So the economy is underperforming if we find ourselves in a recession. Businesses are underperforming, the economy is underperforming, families are not doing that well. Unemployment rate significantly increases above the natural rate of the market. And we may have situations that can induce a recession. For example, earlier this year in 2020, we had a severe crisis in America. A recession could be on the way, or we are already going through one and recovering, depending on how quickly the economy recovers. Due to the world pandemic, the COVID coronavirus crisis. Right now, as of earlier this quarter, the second quarter of the year, the U.S. had 22 million people filing from unemployment or were out of work. That was on a weekly basis, people were getting laid off because of the COVID crisis. Something the economy started to underperform because things had to shut down. The U.S. oil barrel fell significantly below $0. That's never seen before in history. So we went into a potential recession due to the economic shutdown. The economy was underperforming here. The economy was significantly underperforming, so it was not in long run aggregate supply equilibrium with the aggregate demand. It was significantly, it could have reached zero, but that's nearly impossible. So if it falls below its economic activity for 2 consecutive quarters or more than 6 months, and a recession could be induced. But luckily, the stimulus package and so on that the government implemented might have stimulated economic activity to prevent it from going into a deeper crisis. The secondary thing that the economy can experience is an inflationary period or an inflation gap. And an inflation gap typically occurs in the economy when the economy overperforms beyond its productive capacities. So during an inflation gap, we have a situation where the economy is performing significantly at a greater level, and the unemployment rate may be significantly lower because the economy is overproducing. The unemployment rate has fallen below the natural rate. It could be significantly less. There's more workers that are needed, so there's a shortage of workers. And as it sounds, inflationary periods mean that we have a high price level or a pressure on the price level. The price of goods and services are increasing. And during the inflationary gaps, we could have an unstable currency because it could overinflate if it gets out of line with the economy's productive capacities. Some inflation is good. Keep in mind, stable inflation is good. Over time, stability in prices is crucial. If they are increasing by 1 to 2%, some inflation is good. When it increases above the normal parameters, that could be a bad situation because the economy can go into an inflationary gap period that it won't be easily to resolve unless there's some monetary packages that resolve the inflation rates. So the inflation gap can also be modeled. The inflation gap or the inflationary periods, they refer to a condition when the real economic gross domestic product or real GDP of the economy is operating at greater capacities than the natural rates of the economy. Or think about when you're overperforming beyond the natural ability of the market. And the natural ability of the market here is captured within the inflationary model. The price level is on the vertical axis, the real gross domestic product on the horizontal axis, and we have the short-run aggregate supply on the upward sloping, the aggregate demand downward sloping, and the economy is operating to the right of the long-run aggregate supply curve, this vertical line. So the economy, the real GDP, is operating at a greater capacity above the natural levels of GDP, which is QN, natural output of real GDP. But basically, the economy has to be more or less intersecting the long-run aggregate supply in the economy to be considered in stable long-term equilibrium. If it's deviating, in this case to the right, the aggregate demand has shifted up, and the aggregate supply, it's in this case upward sloping. The economy is operating above its productive capacities, and the real GDP is greater than the natural rate of natural GDP, and there's a gap. Whenever there's a gap, we either have an inflation period or a recession. In this case, we have an inflation period. And you can only operate on this gap for so long, unless the long run equilibrium, long run aggregate supply curve shifts to the right. You can only operate this on so long because the economy could overperform. And if it overperforms, it needs to be stabilized, or it needs to be normalized by certain economic policies or public policies to make sure it doesn't perform or overinflate. There could be low unemployment because the economy is performing above its natural capabilities. Either the short-run aggregate supply moves to the right here and creates a new equilibrium, or we have to adjust and deflate the market to close off this inflation. Again, some inflation is good, but too much inflation could be bad for the currency, for the stability of the economy, and for the conditions of the market. So the inflation pressure could continue increasing the price level, and that can lead to continuous or ongoing inflation. That could be a bad situation when for the country, for whoever's experiencing, whichever country is experiencing an inflationary gap. Overperformance is okay for a short period of time, but not for long-term capability. Ideally, in the market, once we account for recessions, inflation, sometimes the economy will have recessions, sometimes the economy will have inflation periods. The economy will reach long-run equilibrium. And long-run equilibrium is when the economy is performing its natural capacities. Actual real GDP is equivalent to the normal abilities of the market. So we have real GDP is equivalent to natural GDP, and the economy is performing at its full capacity. It's employing full resources, and there's no wasted opportunities. There's no gaps either to the right or to the left. We have stability in the market. The economy is growing. It is consistent, steady state. At the price level on the vertical axis, real output, and the horizontal measured by GDP. In long-run equilibrium, the economy is intersecting the long-run aggregate supply along with the aggregate demand and the short-run aggregate supply. We should always technically be somewhere around the equilibrium. We're not always in perfect equilibrium. Sometimes we're close to, but not quite, because there's always things that happen. But for the most part, long-run stability tends to be okay. It's steady growth. The economy naturally grows in the long run in steady levels. As long as during certain years we have no major contractions, no major inflation periods, the economy grows steadily. So in equilibrium, in the long run, price level for long-run aggregate supply is intersecting the short-run aggregate supply and the aggregate demand curve, all in equilibrium one. When the economy is here, the natural level of GDP is equivalent to the real economic activity of GDP. Both of them are in equilibrium. So in long-run equilibrium, the unemployment rate is close to the natural unemployment rate, if not their equivalent. In the labor market, most people are working, employed, and things are going well for most families and most businesses. And here we have a chart that has the three stages. If real GDP is below natural GDP, we have a recession, and the unemployment is significantly greater. If real GDP is greater than the natural GDP of the economy, we have an inflation period. And during inflation, the economy is overproducing, employing everybody, so unemployment rate may decrease. And in the long run, when we have long-run equilibrium, real GDP, the real output of the economy, is equivalent to its natural abilities to produce, and we have unemployment levels that are normalized, and they're equivalent to the natural rates of equilibrium in the market of the market. So in equilibrium, things are going well for the economy in general. The three states of the economy further analyzed. We can actually analyze the recession, the inflation, and long-run equilibrium using a simple production possibilities frontier model, the PPF model. The idea is simple, but the graphical illustrations may look confusing, especially because of how they're modeled. But we have the same idea with the production possibilities frontier model, which illustrates a simple economy that is operating within its productive capacities in the market. and we're going to call the PPF specifically an institutional production possibilities frontier, which is institutional PPF, and the physical abilities of the economy to produce goods and services. So we have the two lines that represent each. The institutional PPF we have been represented by the blue, dark blue here. This is the institutional capabilities of the economy to produce goods and services within its institutions, physical institution. With its institutional abilities. It can produce all type of goods and services, considering the production of good X. The economy can produce any point along the institutional factors here. Point A, point B, and point C can be produced. Anything within the institutional PPF, it's underemployment of resources, underemployment of institutional factors, and underemployment of physical factors. If the economy is operating outside its institutional capabilities, the economy will be operating at point D, and this may be an indication that we're over expanding our institutional abilities, and we are exercising all that we can, all of our physical abilities, which is the second curve. We're approaching that limit. So if the economy is here, then the unemployment rate is significantly less because all of the physical factors are almost fully used significantly and even more. So the unemployment rate is significantly low, and the actual unemployment rate is low. So if we are operating at specifically at point A, point B, and point C, we're operating within the economy's productive capacities on the actual curve, which is institutional capability PPF. Within both institutional and physical, we're underperforming. Somewhere in between, we're overperforming. To operate on the actual physical PPF, we're reaching our maximum capacities. The maximum capacity on the actual physical PPF, it cannot be sustainable for long periods of time. Anything outside is not yet possible and not yet achievable. Let's analyze this further. A little bit more complex. A simultaneous model with with several analyses attached. We're going to start one by one. We're going to start with point B. Point B, although this model is looks like a spider web, it's all over. So here we have the production possibilities frontier, the institutional PPF, and the physical PPF. All of the goods and services can be produced on the y-axis, and all of the goods and services that can be represented by good X on the horizontal axis. So we have the center of it here is the institutional PPFs and the physical PPF right here. We're starting with point B. At point B here, this model indicates the production abilities of an economy that can operate either at point B, A, or C. And at point B, the economy, this basic economy, is producing on its institutional factors, the institutional productive capabilities of the economy, and it's considered to be in long-run equilibrium, captured by this model. Basically, we are in equilibrium. The demand for goods and services, the aggregate demand for goods and services, is equivalent to the production of goods and services represented by the short-run aggregate supply curve, and it's consistent with the long-run aggregate supply abilities of the market. So if we are in equilibrium 1, if we are in long-run equilibrium, the economy is producing output that is equivalent to its natural capabilities of production. And represented by the PPF, we are right at point B, which indicates that we're operating within the institutional factors of the economy. Point A is indicating that we are underperforming within the production capabilities at the institutional and at the physical level. Point A is indicated here that we are underperforming, and anytime the economy underperforms and performs below its productive capacities, it's facing a recession and underemployment of resources. A recession is indicated by this model that shows the aggregate demand and the short-run aggregate supply operating below the long-run capabilities of the economy, and we have a recession gap. And when we have a recession gap, the level of real GDP is below the natural levels of GDP, and the economy is underperforming, captured by the underperformance of the PPF model here, point A. And during recessions, we have high unemployment, low economic activity. We're performing below at our institutional factors or physical factors, and we are in a recession. Point A, underemployment, in this case of resources, or high unemployment of people, low economic activity, and point B indicates the economy in long-run stability, and as long as they're producing along the institutional PPF, point B. Point C indicates that we have exceeded our institutional factors. Our institutions are operating beyond their capacities. We need more. So here we are represented here as outside, or we're exceeding our institutional formation, and we're outside our institutional capabilities. We're almost approaching our physical abilities. Some people say, well, what if we produce at the actual physical capabilities? You can, but only for a short period of time, because you're physically exercising all of your physical resources or factors in the market. So that indicates the inflation model. The aggregate demand for goods and services and the short-run aggregate supply of goods and services, it's greater than the long-run capabilities of the market. Basically, we're overperforming beyond our long-run ability, which is represented by this vertical supply curve. The quantity in natural levels of the market of real GDP is represented by the green curve. It's greater when the aggregate demand and aggregate supply are to the right, and the actual GDP it's above capacity. So we have an inflation gap, and that is captured here at point C. Inflation at point C. This is a PPF that basically explains the recession model, the long-run equilibrium model, and the inflation model, all within the institutional and physical capabilities PPF model. Very interesting, a little more models analyzing this particular same scenario with different perspectives. Now, what happens and what do we do if we have a recession, if we have an inflation, if we're operating below or above? What do we do? Well, according to the classicals, this economy is a self-regulating market economy. Their perspective of the economy is that the economy will self-regulate if we are experiencing any economic effects like a recession or inflation. So if real GDP is less than the natural capability of the market or the natural level of GDP, the economy will self-regulate. If the unemployment rate is significantly higher than the natural rate and we have high level of unemployment, the market will adjust, the labor market will adjust, wages will adjust, and it will self-regulate. The view here is that the employers will recognize that there's high unemployment, and there will be a decrease in the wage rate, and this decrease in wage rate, it will be a flexible adjustment process, and the market will self-regulate. So during a recession, it is perceived that the economy will self-regulate, meaning that it will self-heal. Some of you may be thinking, well, that's very contradicting. How's that possible? Well, it was tested actually. It was put to the test during the Great Depression of the 1920s. During the Great Depression of the 1920s, and even more after, there were many crises. The real GDP has fallen below natural levels. The unemployment rate has increased significantly, and the wage adjustment process doesn't always occur. So let's take a look at the perspective of the classicals. If we are experiencing all of this crisis, the classical laissez-faire perspective believe that the economy will naturally correct itself. Give it some time. The market knows best. The embedded market forces within the market will recognize the issue, will recognize that there's low output, low GDP, that there's high unemployment. There will be an adjustment process, and the economy will naturally correct itself. The market knows best. the market has the ability to recover, which had worked in previous instances, but it was put to the test during the Great Depression, and things were bad for 2-3 years. And why was the economy not recovering? It's because the economy is more complex than just leave it alone. Let's analyze this further. If we do have a classical perspective, meaning that the economy will naturally correct itself, what are the corrective transition mechanisms that it will naturally correct itself? Let's look at this model. So we're going to start with the economy in a recession. The economy is in a recession in this model. The economy is in a recession. If aggregate demand and aggregate supply are in equilibrium 1, P1, quantity of 9, the real level of GDP here, it's 9 units. The natural level of GDP, it's 10 units. We are underperforming. We have a gap of 1 million units. At a quantity of 9, we have unemployment, high unemployment, and here the price level is P1. So we have a recession. What will happen here, according to the classicals, or the classical perspective of the economy, as you can tell, I'm not so much of a classical, is that we're going to have a self-correcting mechanism. In panel A, the economy is underperforming and is finding itself in a recession where the level of GDP it's 9, the level of actual real GDP it's 9 units, and the natural level of GDP is 10 trillion units. The economy is in a recession gap, and the unemployment rate is much higher. According to classical theory and classical view of the economy, the wage adjustment process, because one of the conditions that we saw earlier, the classicals believe that prices and wages are fully flexible, meaning that they can adjust. And panel B indicates the adjustment process of wages and prices. So here, the suppliers of goods, the producers will recognize that we are in a recession. So what would happen here on panel B is that the supply curve here, which is not in equilibrium with the long run aggregate supply curve, they have to be perfectly intersecting. There's going to be a decrease in the wage rate. Wages will decline, and then with lower wages, it would increase the production of goods. Wages drop, people become employed, they increase production, so the supply curve will shift to the right. We have what is called a balance effect. The price level drops because both of them are flexible. Wages are flexible downward, and prices are flexible downward. Prices decline, both prices decline, wages decline, and the supply curve shifts to the right. Actually, the first thing that shifts the curve to the right is the wage drop. Lower wages decrease, that shifts the supply curve to the right, and we go from E1 to E2. At E2, we are now in the aggregate demand and aggregate supply in long run equilibrium at point 2. Since the price is flexible, the price lowers and it drops, and ultimately the economy moves from the recession gap to long run equilibrium through the wage adjustment and price flexibility process. This is basically the market will recognize that we need to increase the supply to get out of the recession. We need to lower wages. The workers are going to accept those lower wages, and we're going to produce more, and the economy will self-correct itself. But as we have seen in real life, that's not always the case. Wages don't drop, and prices may not be flexible downward. But that's the view of the classicals, what you do in a recession during a self-regulating economy. Now, what happens actually is that if we let this adjustment process occur, we could have what is called a slow recovery. Sometimes the economy can take a long time for this to occur, to accept this particular transition mechanism. If it takes a long time, it could take months, it could take years. During the Great Depression time, it took several years for the economy to actually went into a depression, and people were wondering, well, why are we not getting out of this crisis? There were a lot of factors to begin with, actually, but the economy was not recovering. GDP can actually take a long time for it to go back to its regular level, and then to begin to expand, it could be a lot longer. So the economy could move relatively slow, and sometimes people cannot wait that long. Businesses cannot wait that long with low customers' demand, And families that are laid off cannot wait that long, can wait years. We cannot let this self-regulating mechanism naturally correct itself or leave it in the hands of the market. The longer it takes for wages to adjust, because they would naturally adjust if we leave them to adjust, the slower the recovery will be. And often cases you can, first of all, if you're lowering the wages for the public, they're going to take less income to their homes and less income to spend, and the price has to drop. It's possible, it could happen, but it's actually tested severely that we can't wait that long. Until COVID-19 was a great example. You can't wait that long for the economy naturally to recover. If there's a pressing matter, government needs to act. So the self-regulating economy is don't intervene, let the market work its forces, let it work itself out of a crisis, and leave it alone. So now let's take a look at what would happen if we are in an inflation. What happens if we're in an inflation in the economy with the classical perspective? Well, during an inflation, we know that the level of real GDP is higher than the natural level of GDP, and the economy is overproducing and is overperforming. So we have the unemployment rate is low, so that could be good. You may be thinking, well, if the unemployment is low, is less than the natural rate, why would we even want to slow it down? Well, you want to cool off a overheating economy. It's like when your car is overheating. You can run your car if it's overheating. You can drive the car, you can drive it pretty good. It overheats. You can ride the car for a few miles, a few minutes, an hour overheating, but eventually it will blow up. So you need to cool off the engine. So it's the same. It's a similar analysis, an analogy to here. You want to cool off an overheating economy or an inflating economy, and to do this, the idea here is with the classical is that we need to increase the wage. We need to increase the wage. Again, the transition mechanism happens through the wage rate. The wage rate. If we have an overheating economy, increase the wages to increase the cost of production, and the supply of goods will decline. But if you increase the wage, you might end up with cost push inflation even more, because wages increase, the supply of goods declines, but you end up with a higher price level, and it could be counterproductive, or you may end up with cost push inflation. So the economy could reach what is called long-run equilibrium on its very own with a self-regulating mechanism through the wage transition mechanism, assuming that wages are flexible. And to do this, we need to, the market would increase wages, and firms will cut production. So wages increase, firms cut production, and that cutting production will move the economy back to long-run equilibrium. Let's take a look here. So we're operating, and this can actually see how the price level can increase. We're starting with the inflation model because the economy is in an inflation period. The economy is in an inflationary gap, an inflation period. The economy is at price of 1 and GDP of 11 trillion. So real GDP is greater than the natural level of GDP here. So we have real GDP is 11 trillion, greater than the natural long-run aggregate supply GDP of 10 trillion. So we have an inflation gap. The economy is considered to be in an inflationary period whenever we have a gap. We have low unemployment rate is low, the economy is producing well. Some people may wonder, well, why should we want to slow it down? Shouldn't we expand it further? And you can expand it, you can continue operating if you could sustain it. It's just not recommended. The market would naturally cool it off. It's possible, or things in the economy can happen and create a cool-off mechanism. Here we're assuming that the market will recognize that we're not assuming, we're just, actually seeing that the market will recognize through the wage transition mechanism. And the way to do so here, it's the wage rate. On model 2, the economy adjusts through the wage rate. The wages are flexible. So the supply curve SR1, S short-run aggregate supply 1, is going, if wages increase, if the wage rate rises, with wages increase, wages are an input cost of the production. With higher wage rates, the cost to produce goods and services will increase. The supply of the good will decline. That's the logistical analysis. Higher wages lead producers to decrease their supply of goods, and we end up with a shift in the supply curve. The supply curve shifts to the right, to the left, to SRAS2, and with the higher wage rate, the price level increases to P2, and we are back in the natural economic capabilities of the market in long run equilibrium. But if you notice, the price level after that is even higher. So this is why I mentioned that inflation could be bad for the economy, because it can lead to more inflation in the economy. So if you want to cool off and slow down inflation pressure, because the price level, since they're flexible, prices here are flexible upward, they're going to increase more. Then you're going to have to, if you increase aggregate demand, it's going to continue on and so on. So here we have, as the price level rises, we have a real balance effect situation where it may affect the interest rate, it may affect the demand for goods and services, and so on. So we're going to decrease the aggregate supply to the left. The economy goes back to long-run equilibrium at 0.2, and we're back to equilibrium. Here we're just focusing on the wage rate effect, and so on. Okay, good. The self-regulating economy. We have some policy implication in believing that the economy is self-regulating. The view is still very common, even today. And it's not just that the economy is self-regulating, it's just that the market knows best. It's a free market economy. The market forces can stimulate economic activity. It's a better saying, it's a better idea. So that is referred to as laissez-faire economics. Laissez-faire economics is a point of view that specifies that do not interfere with the economy's affairs. The economy knows best, the market knows best, so leave it alone. Any public policy should not directly interfere with the market activities in the economy, because it would hinder its ability to promote economic well-being. The economy will always move back and recognize any issues, any fluctuations, and adjust to natural GDP levels. And I will argue that if your laissez-faire capitalism is your pro-free market, pro-private sector activity, no regulations, low regulations, let the market function well. But if there's a crisis, you need to do something. A self-regulating economy, the perspective and the view is that it's capable of healing itself through the wage and price adjustment mechanism, along with the balancing effect. However, the big question is that this could take a long time. We have seen it that slow action when things happen prolong a crisis even more. So there's still perspectives even today in Washington of policymakers that follow this laissez-faire capitalist free market approach. Don't regulate, do not interfere. Policy should not interfere, but instead should stimulate economic growth, economic prosperity, economic activity. But we are going to see later on that there's a different view as to how to monitor the economy greatly. Thank you, everybody, for joining the session. Have a good afternoon, and I'll see you next time.